I want to start with the big news of the week, which is the U.S. Treasury's intervention and into the Treasury market, right? How is that intervention affecting credit, if at all? What kind of signal does it send, Meghan, at least when it comes to government willingness to step into the market?
I think we saw the signal, a positive reaction initially in the Treasury market with the rally yesterday, but some of that has been undone and potentially not enough to really keep a handle on 30-year bond yields. So I think the reaction in credit so far to this sell-off in rates has been relatively muted. I think one thing we've noticed is that the correlation between treasuries and credit over the last couple weeks has turned positive. So higher treasury yields, a little bit wider credit spreads. But those moves have been small, and over a long time period, credit spreads very tight. So I think we're being driven more by some of the other tailwinds for now in credit, but of course the risk of a sell-off in Treasury is growing.
Yeah, that correlation is something I want to get to, Milwood. Hyperscalers are all issuing debt. There's going to be more to come. We know that. A lot of it is at the long end. Is that contributing to higher U.S. Treasury yields?
I actually don't think it's contributing to higher yields. What I do think is contributing potentially is just where are we on the macro? And so I think at some level we're sort of reevaluating. We've got war. We've got movement in spreads, we have volatility in the markets. And so at some level, we're just really assessing where we are in relation to the risk in the macro.
Okay, well, let's go back to supply here. And I'm going to re-request that chart that we showed earlier about all the activity in August. September, typically a big month, we know that. But I wonder what the pipeline looks like, Meghan, because you look at what we've seen in August, and it's been pretty incredible, right? Hitting a new investment-grade sales record so far. I wonder how much of it has been pulled forward by the activity we've already seen. People are very mindful of the fact that Anthropic and OpenAI are getting ready to go public, and they will likely follow SpaceX's lead and issue debt soon thereafter. What does the pipeline look like, Meghan?
So looking into September, what we see so far is a 200 billion or so pipeline, which would be more than August, but not a record-breaking number like we've seen in other months. And I think one factor is hyperscalers. We do think a secular trend of greater borrowing into 2027 is certainly expected, but our forecast for 2026 for the scalers and public issuance, we're pretty close to that, and we still think it's a reasonable number. So we have a 250 billion hyperscaler forecast for this year. We're at 220 billion, so we think we could get another deal, but sort of this deluge of supply we've seen over the last couple months from the scalers, we think could slow down, at least in public, giving way to some relief in September.
I wonder also, Milwood, if there's a rush to issue now before rates perhaps go even higher, because who knows what's going to happen in the coming weeks and months, especially before the midterm election, as well as perhaps a Federal Reserve rate hike down the road. Do you see that, or do you think that's a part of it?
Look, I think there's a roughly 10 trillion of capital that needs to be raised. Offsetting that is 10 trillion of economic productivity. So I think we're a little bit less focused on the immediate and more thinking about the long term. And I think rates, while they're moving, I think you've seen the performance in the public market of these hyperscalers. CoreWeave had good earnings. And so there's decent momentum, and you want to issue into that momentum. You don't want to wait. So I think you're going to issue, and you're going to see continuing issues because of the capital need that we have out there.
And of course, the hyperscalers are issuing credit. They're investment grade, but there's plenty of tech companies that aren't and haven't been. Meghan, the CCC spread is the widest since going back to Liberation Day. And that speaks to the stress of weaker borrowers as rates stay kind of elevated and borrowers need to refinance as well. The original issuance was, 2021 when rates were super, super low. It's now 5 years out. What does the wall of refi look like? Just give us a sense of scale that we should be bracing for.
Yeah, so the refi maturity wall, we haven't been discussing it much this year. We've had a break from it, but it is approaching in 2028.
Yep.
And for lower quality CCC issuers, for example, they have to be forward looking. So we look for 15 to 18 months in advance that they would start to address those maturities. So from fourth quarter of this year, we'll start to see how some of that is addressed and if it can be refinanced. For us, the bigger story is not interest cost for these issuers, it's really the earnings picture. So earnings has been so resilient that even though borrowing costs are high, coverage still looks pretty good. So I think we're watching that earnings as a bigger risk, a drop in earnings versus taking on an incremental borrowing cost for now.
How are you thinking about that?
Yeah, look, actually, interest rates have come down. If SOFR peaked in the low 5%, it's down to like 3.7. So coverage levels have actually improved. I think Meghan's right that the macro could be one of the issues out there. But look, there's a maturity wall of 27 and 28. A lot of that is in smaller businesses and tech. And so while there's been some view that AI has sort of created this noise or around the software, I think it's really the fact that interest rates went from 0 to 5%. And TEVs on those businesses have dropped because in 21, 22, we weren't sure if we ever go back to work again. And so I think you have to sort of digest that. But the maturity wall in 13, 14 ended up not being an issue. So we could turn around and see that maturity wall gets solved pretty easily.
But as Meghan said, you're going to start looking for these companies to come up with, how they're going to move forward at the end of this year. Are you, as someone who invests in private credit, offering them private solutions?
Of course. we think the market for private credit is actually pretty good right now. 24 and 25, the issue you had more capital than opportunities. And with the outflows in BDCs, which I think has been a news line this year, you're actually seeing a little bit more balance between the two. And risk is being actually better priced. And so we're being more judicious about deployment of capital. We think sponsors today are more focused on execution and deal certainty. And at Brookfield Oaktree, we're sort of wanting to be the provider of choice. And I think that is a focus of ours. And we think that the market for private credit is actually pretty good.
So let me just stay with you for a moment here. What opportunities do you see as attractive right now, Milwood? Which sectors, and we can go beyond software because of the moves that we've seen there, which is obviously more distressed than others. Are you looking at, say, chemicals or healthcare?
So we tend to price risk. So we're open to all industries. I think what's interesting is because the software is not as interesting for some folks out there. The other sort of opportunities tend to be priced technically pretty tight because everyone is in those opportunities, whether industrial, business services, consumer. We've done some consumer deals recently that were actually pretty interesting. So I think there is a market out there, and I think there's an opportunity to deploy capital so long as you're focused on price and risk. It's so long as you're focused on really looking at the situation over a cycle.
Meghan, what do you think about the consumer side? Because retail sales fell unexpectedly last month. The retail earnings, Walmart's numbers, for instance, this morning show that consumers at the low end are not spending as much as we might have thought they would. So clearly that has implications for paper issued by consumer companies.
Exactly. I think we continue to see, it's been in vogue to talk about the K-shaped economy. We continue to see sort of the lower income cohorts struggle. We position within the consumer, we avoid areas more exposed to things like restaurants in the high yield space. In terms of issuance, a lot of those type of sectors exposed to lower income haven't been borrowing as much. So they are the more rate sensitive type of sectors. And it's one reason why spreads overall have remained pretty tight because the issuance has been very bifurcated between these new economy tech type of names versus the old economy.
And, I think about what else has been happening on the macro level. We had this intervention in the yen by the Treasury Department, and it's made it cheaper for foreign investors to hedge in their own currencies. So, Meghan, I'm curious, is this increasing demand for U.S. credit at all?
We haven't seen an increase yet. I think that it really depends on the region. So demand this year has been very strong out of Taiwan. They've seen inflows into their US dollar insurance policies. Japan has been an area of a little bit of weakness. So I think just the instability in the currency and hedging costs are still relatively high. So I think that buyer base has more taken a back seat for now and sort of waiting to see more stability either in the JGBs or in the U.S. bond market. All
right. Well, as we wrap up our conversation, Milwood, I'm curious how you are getting ready for September. Once this quiet period kind of goes away and people are back at their desks, whether it's the flood of issuance that we can anticipate, any kind of rate hike from the Federal Reserve, the final weeks before the midterms, the volatility that we might be gearing up for. What are you getting ready for?
Look, I think the volatility, we like volatility, right? Because I think that it gives us an opportunity to price risk. And we, as you know, Brookfield Oaktree, we we have sort of outperformed or out originated during those periods of volatility. So volatility is actually a good thing for everyone, I think. But going into September, look, I think the consumer is pretty important. Higher interest rates further constrains cash flows. And I think the lower end consumer has not been that active for a while. Credit at banks is being sort of tightened. So we got to watch for that. We got to watch for banks and what they're going to do on the credit side for these consumers who are not necessarily have the free cash flow they used to have.
How about you, Meghan?
So into September, we like banks over corporates still, I think, in terms of positioning where you can kind of hide out in the belly of the curve versus avoiding some of the longer duration. I also think leveraged loans look attractive within the LevFin space. We have a call for three rate hikes beginning December, and that should benefit the carry of loans versus fixed rate.